It's fairly easy to look at a price chart and to come to a conclusion about whether the market regime is currently that of a trend, either up or down, or not trending at all, so maybe in some kind of trading range. But for algo traders, we don't want to sit staring at charts all day. Instead, we tell our algorithm how to interpret the price action in a programmatic and quantitative way, so that this can be done automatically to help determine what the prevailing market regime is. Now, one way of helping with this classification is to use indicators. By interpreting information given out by those indicators in a systematic way, means that our algos can then perform the classification and adjust their rules accordingly. So for example, by deciding whether or not to trade in the opposite direction of a prevailing trend, and by doing this correctly could contribute to turning the probabilities more in your favour. Stay tuned. So as I said in the introduction, we're going to continue the theme today of looking at how we can use indicators to help us classify the market regime. So we're now moving on from using the trend following indicators to identify a trigger point for our trading system. But if you missed that episode, I would recommend that you watch that, because it provides valuable information not only about how you can potentially use these indicators, but also starts to highlight some of the issues. Now, these issues are actually something we're going to start addressing by looking now at the market regime. And as I said before, especially if you're an algo trader, you need a way of doing this in a programmatic way to quantifiably process price data in order to come up with that classification. And in order to do that, in the examples I'm going to use, I'm going to continue using the moving average. And over the next 3 episodes, I'm going to look at 3 different ways of doing that, but all using the moving average indicator. Now, using indicators in this way is slightly different to that when you're using them to provide a trigger. A trigger is an event that happens at a moment in time that you either need to act on or ignore. Whereas when using indicators for regime filters, this classifies the market for extended periods of time. And by taking account of those market regimes can help to avoid false triggers. And by doing that will help to increase the probabilities in your favour. So the first way we're going to look at in terms of classifying the market is by using just a single moving average. But here, we're not particularly interested in the turning points like we were for triggers, but rather now we're looking at the slope of the moving average. And what you'll see is that when that slope is moving downwards, as you can see here, that's generally a good indication that the market is in a downtrend. And when the slope is moving upwards, it's an indication that the market is in an uptrend. Now that's all fairly basic, but in terms of giving us information that we can quantifiably process, it's actually invaluable. Because by using a simple calculation to determine what the gradient is and whether that gradient is positive or negative, means that we can perform that simplistic categorization of the market. And by looking at a chart in this way, generally speaking, you can see how that would work. However, you need to be really careful here. The brain tends to see things that it wants to see. So just looking at a chart in this way, without quantifiably categorizing it, can be dangerous. So let's take a look at what happens when we do perform that quantifiable research. These are the categories that get determined by using that simplistic approach. The areas in green are where the moving average is moving up, and the areas in red are where it's moving down. So green signifies an uptrend and red signifies a downtrend. And I think you'll agree that by going through this exercise, the challenge is actually a lot more complicated than we might think. What you will notice though is that when there is a strong trend, like this downtrend we see here on the left-hand side, the indicator tends to do a very good job of classifying that. However, when the trend isn't so clear, the categorization is much more sporadic. And those statements are actually a really good summary of how trend following indicators operate. When they work really well, but when they don't work, you get lots of false information. Now, those of you that have watched some of my previous episodes would have seen when I used the Aroon indicator to do a very similar task. The difference here is that the Aroon is an oscillator, and we have these two lines, the green line, which is called the up line, and the red line, which is called the down line. And the trend is determined by looking at which of those lines is in this upper region. When it's predominantly the green line, it means that we're in an uptrend. When it's the red line, it means that the price action's in a downtrend. So using Aroon, this is what the categorization would look like. Now, just one thing of note before we actually compare this with the single moving average. This is using a simplistic interpretation of what the Aroon indicator is telling us. So the rule I've used here to perform this categorization is simply one which looks at which line, the green up line or the red down line, is higher. And the result of this type of interpretation of the indicator is that it can only classify it as either being an uptrend or a downtrend. Now, there are more sophisticated ways of interpreting Aroon, where we have this middle ground, where there isn't either a trend in the up direction or the down direction. But in order to compare the results like for like with the simple moving average, which can of course only classify into those two categories, that's why I've done it in this way. So let's now compare these side by side. Now the first thing you'll notice here is that they're actually very, very similar. And for all of the major parts of the chart, they come up with the same interpretation. One difference, however, is that you'll notice that the single moving average is much more erratic. So it changes from up to down as we see during this trading range here. Whereas the Aroon indicator is slightly less sporadic and it changes less often. And that really brings us on to one of the major disadvantages of using a single moving average for this particular process. And that's because it has no ability to be able to classify the market as not being in a trend. Which is why when it isn't in that trend, as you can see in this region on the right of the screen here, it really struggles and flips between one or the other. But that's where the second technique comes in. And in the next episode, we're going to start looking at a dual moving average technique. So using two moving averages. And here we'll look at a simplistic version, which again will just classify into either an uptrend or a downtrend. But it does now give us the ability to classify a third categorization, which is not trending. And that's the more advanced version that we can use with the dual moving average. So if you want to, you can click top right now to go straight to that next episode if it's available. If not, then please do subscribe and you'll get notified when that episode becomes available and also any future episodes. But that's it for this episode, and so now until next time, trade safe.